Hey everybody, I'm Jack Campbell with Keller Williams Realty, and I've got here today with me one of my best buddies here, John Schuler, and there's a real good reason he's one of my best buddies. He has been a huge help with our clients. He's a lender with Arbor Financial, who is a broker banker, which means they really kind of have the best of both worlds. But I want to thank you first off for coming today to share some knowledge with our clients.
Yeah, you're welcome. I'm excited to be here. So thanks for the invite.
Yeah, it's the reason that I advocate for him so much is that he's got a huge amount of knowledge in and around the mortgage industry. I spent 13 years in the business myself before transitioning to real estate, and having had the background in the mortgage industry has given me a lot of insights to what it is that I expect and really high standards. And I've not met a whole lot of people. I would say actually of all the people I've met, I hold you in the single highest regard of all the lenders that I've ever worked with. So thank you for that. That's huge.
Yeah. No, thanks, Jack.
And
that's
the ethics and, having been starting in the military, being a Marine, then going on to law enforcement, and now 18 years in the mortgage industry. I mean, it's not your first rodeo here, is it?
No, it's not. And that's what I love about you is because you get my industry, right? So we're on the same page on every transaction. So it's great.
Well, I appreciate that. So the thing I wanted to cover today and just kind of talk about was what's going on with the market. I mean, just taking a look at the big picture of what's happened over time in the last 2-3 years is obviously we went through a pandemic. We had huge amounts of cash from the Federal Reserve pumped into our markets, pumped into our securities, which obviously affect the mortgage-backed securities, and it's all in an effort to cover or help with an economic situation that nobody really understood. So a lot of this has been pumped in, and now we're coming off the back of that. And now, there's conversations about inflation, there's conversations about economy, the economy slowing, we've got a war brewing. I mean, I don't want to dive into any of that really. What I'm interested in talking about is now that we're easing our way through all of these issues, we're coming to the backside, and things in the mortgage industry are looking a lot different than they have in the past. And so I would really love to pick your brain, having such a high respect for your knowledge and your in-tuneness with the mortgage industry. I mean, what do you see big picture wise moving down the pipe? I mean, is the world coming to an end?
It's not, right? Now, so just quick overview. After the last crash in 2008, the reason why it crashed, there's a lot of bad loans, right? The banks didn't really have their stuff together. They really loosened the guidelines. And so after that last crash, a lot of safeguards were put into place, right? So now it's good loans being made. Big picture wise, where we're at right now, consumers, anybody that's been in the market, last couple of years thinking about buying or refinancing, they've gotten sort of used to rates being below 3%, which was incredible, right? I mean, like we never saw that
Pretty
before.
phenomenal.
But when you got to look prior to that, because in 2018 and 19, the 30-year fix was running 4.5, 4.6, even 4.9. So in 2019 we had almost touched 5%. Here we are today in the 5s and 6s. People are a little stunned with that, but we're sort of returning to really a normal market, right? When I bought my first house in 97, I remember paying 7.5% on a 30-year fix. And so, I've owned multiple properties over the years, and I've had the the pleasure, let's say, of having rates in the 2s or the 5s or the 4s or in the 6s. So for me and you, it's very normal for somebody entering the market or just playing in the market the last couple of years. You're running into what? Rates are higher? No, rates are normalizing. And the Feds have been very involved trying to prop up the market during the pandemic, and good for them. But I got to look at big picture. Where is it going to go? The forecast coming into 2022 was all of us as an industry thought that rates by the end of this year they were going to hit 4%. Well, it hit that early on in February, right? Nobody knew that it was going to hit such a high mark so quickly. So that took us all for a little loop, right? The consumer as well. But I think the important thing is when a consumer buys a house, they have to know that there's safeguards in place. We're not going to let you borrow more than you really can afford. And the loans nowadays, they're good, safe loans. So think about this. If you as a consumer were to buy a house and you're okay with the monthly payment that you've got right now, even at rates being in the 5s or 6s right now, it's okay. You buy within your budget because there will always be a time, hopefully, that you're eligible for a refinance. Everything's cyclic, So rates will settle. Now, inflation, yes, we're at 8 to 9% inflation right now, right? But the unemployment rate is down to 3.6, 3.7. So we're teetering on, okay, what's going to happen? And nobody knows for sure. The Feds have said, yes, inflation is a problem. And one of the biggest things that the Feds have in their war chest is to, raise the cost of borrowing, raise the cost of funds. So the Feds have committed to aggressively raising the Fed funds. Now everybody sees that and they're like, "Oh my gosh, the Feds just raised rates 0.5% or 0.75%, or what's going to go on?" But that's not mortgage rates, right?
Right.
So what we're looking forward to is the Feds continuous aggression on raising their Fed funds, which will probably cause some sort of recession, right? It'll slow things down, but it's meant to slow things down. And once things slow down, then inflation will come down. And just like every other time in history, once inflation comes down, we're going to see rates settle back down. At what level? I don't know. But
So what I'm hearing you say is the Fed's intentionally increasing the cost of borrowing so that it slows down the markets and gets that inflation thing under control. And once they do, chances are this push to make the cost of borrowing so expensive, they're going to probably pull back on that.
Yeah, they will.
So rates will probably, pull back. What's the forecast? Obviously nobody knows, so I'm not holding you to it, but, I've seen a lot of different varying opinions on how quick something like that would likely happen. What are you hearing?
I'm hearing, in the next 2 to 3 years, rates should settle back down. Now, every forecast during the pandemic has been wrong, pretty much, on both sides of the aisle, right? So it could be quicker, could be, later, but at some point things will normalize again, with the inflation and the unemployment rates and things like that, and the Fed's involvement in the market, but yeah.
So obviously rates are changing, and when that happens, we've been so comfortable with these low interest rates. I think the standard product everybody's gone to is just as default is 30-year fixed, So the world has changed.
You're right.
And with the world changing and these rates being higher than they were,
Yep.
what do you see trend-wise happening in the market to work with consumers? Are you seeing any changes that are?
Yeah, more consumers are now looking towards adjustable rate mortgages, ARMs, because if you take out an ARM that's a good mid-level ARM, 7 to 10 years, you can oftentimes get a lower rate. And still have the stability of your rate being fixed for 7 or 10 years. When everything was really low, 2.25, 2.5.
Go back to that. So you said adjustable rate mortgage.
Right.
So an adjustable rate mortgage, they aren't all just adjustable, right? So like your payment doesn't change every month.
No.
So
You have
tell me about it.
you have an initial fixed rate period, whether it's 3 years, 5 years, 7 years, 10 years. So what your fixed rate is for the first 5, 7, or 10 years, and then after that, your mortgage will adjust 1 time a year or 2 times a year, but not every month, right?
So they're still 30-year loans.
There are,
but they're fixed for that first period, and then they become adjustable after the 3-year, 5-year,
Yes.
7-year, 10-year.
Yep. And one of the things we do, we help the consumer keep an eye on the market, pick that right time if they want to convert it to a regular 30-year fix, so that they have stability, from that point forward. So oftentimes it just saves them, several $100s right at the, at the starting point.
So if the consensus is, I would safely say that the consensus of all the economists I'm reading are suggesting that the higher push for interest rates is going to end up coming back at some point, maybe not down to 3% range, but it's going to improve. Maybe getting into one of these hybrid ARM products, which is like a 3-year fixed, 5-year fixed, 7-year, might be a good way for somebody to enter the market affordably and still have the opportunity to refinance when the market comes back.
Exactly. And with me in my position as a banker broker, I can shop upwards of 80 banks to see who's got the best program, the best rate, that'll fit that consumer situation.
Okay.
So it's the best of both worlds.
What about investors? Anything new on the horizon for investors?
Yeah, they, a lot of the banks have loosened up the guidelines and are now allowing, DSCR, debt service coverage ratio loans.
What is that?
So what that is we as a bank will underwrite the property, not so much the borrower. So we don't have to show what their employment or their income is. We just want them to put 20, 25% down on an investment property. We'll take a look at that property and say, okay, is the revenue generated from that property, is that sufficient to cover the debt you're taking out on the property? And if it is, that's it.
Well,
that's it.
So which makes sense because, right, if the property's producing the income that pays the mortgage, the taxes, and everything else, does it matter what the I mean, outside of having good credit, right? I'm sure that still
You have to
requires
have, yeah,
good
you have
credit.
to have good credit. You got to have the money in the bank. You have to have the reserves. But it's really nice for self-employed borrowers or people that sort of use the IRS tax code to
Yeah.
not show as much income, but they really have the income.
Right.
So it's really nice for them because it makes the process simple, and they're going to qualify as
Yeah.
long as they got good credit and the money.
So on the seller side, right? So the market's changing. We're seeing some market times get a little bit longer than they were before, and things are changing. And I remember, 10, 15 years ago when we were in a similar type situation, that there was opportunities where there were products that would help sellers get their homes sold. Do you have any insight on what kind of products might help with something like that? Are they available today?
Yeah, what we're seeing more and more people like yourself adopt is, having that conversation with the seller, realizing that buyers are a little spooked with the sudden rise in interest rates from just 6 months ago. So now sellers are offering to help with a buy down, right?
Okay.
Buy down the buyer's rate, help cover that buy down cost or closing cost to make it a little bit easier for that borrower to get into that house, obtain a lower payment because values are up, right? I mean, they're up year after year. And now with rates being up, the sticker shock of what that monthly payment is hitting people a little bit more than it used to.
Right.
So having the sellers participate in a buy down on the rate is really a great option that we're seeing. So
Okay. So buy downs are
Yeah.
back, basically.
yeah, buy downs are back.
They're
right?
back.
And so are arms, right?
So and I guess
So-
it would be cheaper to pay 1% or a point of a loan amount to help the consumer, the buyer, get a lower payment and afford a higher price.
Yes.
So you get a net higher price as a seller, the buyer gets a net lower payment, and everybody, it's kind of a win-win situation.
It is,
So, okay.
they might decide to pay 1 point or 2 points. So
Yeah. Well, I know we covered a lot.
Yeah.
And there's probably so much more we could probably
there's so much more,
get
right?
to. Yeah, there always is. But thank you so much.
You're welcome.
For coming today to share the information, because I know everybody out there, all this information is new and it's ever changing, and people are nervous. And having a seasoned veteran like yourself, I mean, literally a veteran, but
Yeah.
having a
No pun
seasoned
intended,
veteran
right?
and a mortgage veteran
Yeah.
here with us today to share that information, that's super valuable to everybody. So
Yeah, you're welcome,
Thank
Jack.
you so much for being here today.
My pleasure.
Appreciate it.
Okay.